He's considered to be a master stock picker when it comes to mid and small cap stocks. And here's an interesting data. Reliance Growth Fund, the fund which he manages, has given a return of, hear me out, I checked the data twice, 80x in last 19 years. Sunil Singhania, the man who manages this fund, joins us live. Sunil, 80x in last 19 years. Mutual fund data says past performance is no guarantee of future. Can you return this much again in future?
I think the way India is progressing, we are definitely looking at good returns. Whether this, again you get that kind of return is something you'll have to bear with me for 19 years. But I think the past has been good. The future looks more exciting. So let's hope for the best.
Okay, Sunil, I'm going to take the topic away from what kind of returns your fund can say. But, the reason we got you here today, the most pertinent question being asked, Modi government's one-year report card, and evidence quite clearly is speaking for itself in the last 1 year, where some market participants are a little disappointed in terms of, policies and reforms not moving as per promise, the markets running up ahead of expectations and valuations getting rich. What's your take on what the Modi government has done so far and how the markets have read into it?
I think we have to go in history and see the one-year performance of governments across the world. And when you start to see that, and when you start to analyze our own government over the last 1 year, I think they have done an excellent job. They have put all the building blocks in place across segments, across ministries. I think there has been a clear-cut roadmap of what they want to achieve. They have done it very methodically. The few ailments which were basically being, repeatedly the bane of the Indian economy, whether it was corruption, whether it was transparency, whether it was focus on the right areas, I think they have all focused there. And what we are looking at now is that the base is set, and from here on, if they execute well, you have only good things to see about India. So I think we would say that it has been a very, very good last 1 year. Obviously, we don't have to forget that we are a democracy, and in a democracy, we have to respect and take along all the views. And yes, there have been some impediments, some delays, but I think that's the part and parcel of being a democracy, and ultimately, it wins. So I think we are very satisfied, and we are very sure that the economy will come up trumps, and even the markets after the last 15-20 days of sort of you can say challenges, and that were not entirely related to the economy but a multiple of factors. They will also see the light of the day, and we are already seeing long-term investors again getting very optimistic and very positive on the Indian economy.
Sunil, good morning. Niraj here. 6 months ago, when we interviewed you at your home or office, as the case may be, your tone was extremely bullish on India, and there were select pockets that you were confident will outperform. Is the confidence on the outperformance, irrespective of where the Nifty is, still on?
100%. In fact, as I said, in the last 6 months, we have achieved much more. So the confidence and the optimism continues to be as strong. In fact, in certain pockets, it has increased. At the same time, we have to also remember that, the markets are not like a tap that you open it and, you start to make returns from day one. You have to basically invest with a view in mind. You have to invest with a sort of a time period in mind. And I think there have been some stocks and some sectors where people have been expecting extraordinary returns in 2 months and 3 months. I think those are the pockets which have disappointed. But investors who have taken a view on the Indian economy and the Indian markets from a 5-10 year perspective, even 3-year perspective, I think those investors are as bullish as ever. Those investors are using this opportunity to, in fact, increase their exposure, and so are we. So I think the optimism continues. As I said, there have been some sectors which have performed better than we expected. There have been some sectors which have performed maybe a little bit lower than what we expected, but I think that's a part and parcel of life. We continue to be as optimistic as I mentioned to you earlier, and this Diwali hopefully would be more optimistic than last Diwali was, which itself was a very, very good Diwali.
Okay, so we should tell Sunil Singhania that last time around he joined us at home with Sunil Singhania and he gave us these thoughts. This time he should be in the studio with us to talk about his optimism.
So, Sunil, would you like to block the date on your calendar right away? Every time.
No, we are blocking.
We are blocking his date. The thing that happened with Sunil the last time is that we took him to Worli Seaface to burst some crackers, and he was very, very happy doing that. So we can do the entire show out of Worli Seaface if you want, Sunil.
Done. Closer home. Done.
Sure, sure.
Out of home.
Wherever. I can suggest you some more exotic locations, you know.
Oh, brilliant, Sunil. Not a problem. We'll do that.
So, right now, since you're not in a studio, we are in a studio, we'll have to do a link chat. And my next question to you is that if I look at your top holdings right now, pharma is coming down, IT is moving up, but your largest holding is an agri name. Are you bullish on agri as a theme? And I wonder why, because agrarian economy is under stress and monsoon has been a pain point.
So I think the way the pharma companies in India have established global presence. So they have used the big opportunity in the domestic market to increase their size, to increase their capability, competence, and they've been able to make a mark globally. I think similarly, quite a few agrochemical companies have been able to do that. And we believe that there is a similar or maybe a larger opportunity in the global agrochemical space because it's a much more consolidated industry. And I think a few agrochemical companies in India have been successful in making a mark all across the world. And I think that explains why one particular company finds a place. But as I said, you know, it's basically a pharma industry to the crops. And we believe that India, with its Make in India focus, with its competitive manufacturing landscape, with availability of all the raw materials which go into making agrochemicals, and with the technical expertise which it has developed over the last so many years, companies are in a position to tap the global markets, and there's a huge opportunity. So we continue to be quite optimistic because of that. Just some numbers, Indian agrochemical market totally is only $2 billion. Brazilian agrochemical market alone is more than $13-14 billion. So I think the size of the global agrochemical market is multiple of what is there in India. And that's why we are maybe more positive on the global agrochemical companies based out of India than India-focused agrochemical companies.
A year ago, Sunil gave me similar numbers about the Indian liquor industry, and he gave me the example of the lovely disconnect between the liquor market and the tobacco market. And look at ITC, hasn't done anything in the last 1 year. In United Spirits is moving to 4,000. So, Sunil, where are you smelling that kind of a disconnect and that kind of an opportunity?
See, India is to that extent a very interesting country. We are like America. We are very diversified. We have a huge sort of entrepreneur spirit which is there. We have large number of listed companies. We have presence in almost all the sectors, and that basically makes our job very interesting. I think at this point of time, we are positive on the urban consumption theme. We are positive on select capital good companies, which will include cement, because ministry after ministry is talking about huge numbers, and we believe that in the next 1 year that execution will happen. So whether it's on the power side, on the power transmission side, on the road side, or on a multiple of infrastructure side, there are opportunities. But we have to ensure that the balance sheet of companies we invest is pretty decent. On some of the themes, I think there are 3-4 themes which are emerging. Urban consumption is one. I think brands of all kinds should do very well in India because of the change in habits which we all are witnessing day in and day out. I think food as a category should become quite large. Obviously, we don't have too many listed companies on that space. And healthcare of all sorts, whether it is pharma or hospitals or some clinics, I think they will all again start to show a lot of traction. So I think these three, four mini themes are something which we are working on. Obviously, there are not too many listed companies. The segment is small. But I think they can, work out to be very good themes over the next 5-7 years.
Sunil, I know you can't talk stocks, but I'm just trying to make it easier for our viewers, and therefore I'm choosing a theme which has got only 2 or 3 listed stocks. Hospitals. Now, we hear scores of things from people talking about medical tourism into India and how that's such a big industry that is probably waiting for its full potential to be tapped. Do you believe that the listed hospital space, without getting into a name, is poised for a takeoff over the next 3 or 4 years? I think you quite alluded to that in your previous answer.
See, the listed space maybe is 2%, 5% of the total market in India. So there is a room for a lot many more companies to come up and be listed. We have already seen a lot of private equity deals on the unlisted space in healthcare. And there would be hospitals, pathological services, some specialty clinics, and so on and so forth. So I think this space is interesting, and I don't know about the listed space, but overall, there are going to be a lot of opportunities which will emerge in this space over the times to come. So I think, it's too early right now, but, we have started doing our work. Maybe as and when there are more options which are available, the space would really get very interesting for the listed space investors.
Sunil, you also highlighted urban consumption make the job easier for us, considering it's such a large umbrella with names like Jubilant Foodworks at one end. You've got Marico Kaya. There are so many
Royal
names out
Enfield.
there. Yeah,
Royal
you could just
Enfield.
go on. Yeah.
Yeah, so I think that's very interesting, and we charge only 1%, Ayesha. So let the investors have faith in us and let us do the stock picking.
But what is the logic behind backing urban consumption? Because the trends are not clear. The jury is still out whether urban consumer is making a comeback. Inflation optically may be down, but in general the on-ground reality is very different.
See, Nikunj, we are 15, 20 years behind the developed world, maybe more. And I think that again makes our job easier, because when we go abroad and see what is happening, I think ultimately it is going to percolate down to even India. And there we are seeing, like on the urban consumption side, now we have double income families, so obviously the income is more, the time to do a lot of household work is less. We are moving to a stage where, people want to ensure that what they make, they spend on themselves. And I think that is also giving rise to a big sort of array of consumption related activities. I mentioned to you earlier brands, I think every one of us would aspire to move to a particular brand depending on our, social status. And I think that again will lead to a lot of consumption. Our view is that as the economy grows faster, which was not the case last 3-4 years, urban consumption should pick up, the jobs creation should increase, salary levels should increase to a bit, and with inflation falling, there is going to be much more disposable income in the hands of people, and I think that would lead to an array of increase in consumption, whether it is the QSR space or the branded space or the entertainment space. And our view is that what has happened in the US and what has happened in Japan and what is happening in China is ultimately going to happen in India too. So if Zara, which is out of Spain, which is such a small country, can be like a $50 billion value and a $10 billion brand, there is no reason for the largest apparel brand in India to be only $200 and $250 million. The same would be the case for shoes, the same would be the case for household articles, the same would be the case for restaurants and so on and so forth. So I think the space is interesting, the opportunity is huge, and most of the companies who do well are free cash flow generating companies with very high ROEs. And very sticky businesses. So I think it's an interesting space and it's worth keeping an eye on.
A standard disclosure there, Nikunj and I heavily contribute to Zara sales.
All of us
pretty
do actually.
often.
That's what he's betting on. The more we shop, the more we contribute.
The more stocks he gets. No, but Sunil, just to wrap up the interview, I want to talk about your flagship scheme, that's Reliance Growth Fund, and we all know the kind of stupendous returns it's given most investors out there. What's the sense that you've got in the last 4 odd months when the markets have ebbed off and getting a little wobbly from the 9200 zone? Have you seen more money getting deployed, more money flowing in, or investors are getting a little cagey out there?
I think it's a very good question. Ayesha, this time the maturity which the investors are showing is unparalleled. Earlier you had the scenario where on every rise in the market you had huge money flow in, and on every reaction you had investors withdraw money. I think this time there are a few observations which I have seen. One is the number of SIPs, which is the systematic investment plan accounts, has been increasing month after month irrespective of the market level. So there is this category of investors which is, again very clear now, and rightly so, that the way to create wealth is to be systematically investing, and specifically in a country like India, which is on a growth path. So, if you are looking at the GDP growing from 2 trillion to 4 trillion, obviously a lot of wealth will be created. And I think those kind of investors have seen that SIPs work very well for them. The second big maturity is that on reaction now we are seeing more flows. So investors who are not able to invest, say in May of last year, are seeing that they can invest now in the market at only 8-10% higher than the levels which we were seeing there. And despite the fact that so many things have worked out in favor of India, we don't have subsidy on the fuel side. There have been massive reforms on the FDI front. There is a push towards many more reforms. Oil prices have halved and so on and so forth. So I think on every reaction we are seeing investments coming in. So April was a good month for flows. May is turning out to be very decent. And our view is that this inflows is here to stay. And as we move forward, there is more optimism as far as the flows is concerned. So I think investors have matured, and that's a very good, healthy sign. And in fact, one more thing if you see is in the last 15-20 days of FI selling, it is only because of the domestic investors that there's been so much stability in the market. Almost all the selling by foreign investors has been absorbed by domestic institutional investors. And I think that is where the role of domestic institutional investors become very, very important. I think the government is also realizing this. The move towards allowing pension funds to invest in equity mutual funds is again a very, very positive sign. And we believe that, the way Jan Dhan was such a big success, maybe a plan of that sort to encourage investors in mutual funds will make the domestic institutional investors very healthy and ensure that this volatility because of constant foreign inflows and outflows reduces to a great extent.
Well, it's so heartening to see that foreign institutional investors are no longer market makers and price creators. Domestic institutional investors are making a comeback. Sunil, so broadly, if someone who bought into stocks, let's say last October or early Jan, they are feeling slightly disappointed. They are of the view that we bought stocks and we've been unlucky, and every time we bought stocks in the past, market goes down. What's your broader message? Don't worry, if you have a 3-year time frame, this market will be significantly higher.
Actually, if you see, even if investors came in at the right top in any of the good mutual fund schemes, I think from the top to now, the schemes are down only 3, 4, 5%. So I don't think the investors who have been, very disciplined in their investment approach have cause to worry. Obviously, investors who went in for tips and bought into stocks, which were the sort of, the idea of the day or the tip of the day, they have cause for worry. Our view is that the way the economy is expected to grow, we definitely expect mid-teen kind of returns from equity markets for the next 3, 4, 5 years. So, we are looking at a decent returns, and I think long-term investors should not worry. In fact, any reaction should be used to top up the positions. We are anyway, as an economy, as retail Indians, heavily underexposed to equity. So, it's time to, invest in equity. As it is other classes of assets like real estate and gold are giving negative returns. So I think it makes tremendous sense to beat inflation to be in equity. So, have confidence in the economy, you will definitely make returns.
Left with no other choice as well but to invest in equities, and mutual funds might be a good way to do that. So Sunil, before we wrap up this interview, give us a sense of what are the kind of levels that you're looking at for the index, say, over the next couple of years. I mean, broad base, not a number. And do you believe that somebody who parks money into any mutual fund, not just a Reliance fund, so to say, would be comfortably able to achieve that kind of outperformance from his funds as well?
So I'll answer it in a different way. Our view is that the EPS of Sensex and Nifty should move from around 1450 levels, which we ended at FY15, to somewhere in the region of 3000 to 3500 by FY20, which is a CAGR of roughly between 15 to 20%. And we believe, as I mentioned earlier, that the Indian economy from 2 trillion would in the next 7-8 years touch a size of $4 trillion. Normally, the GDP to market cap is 1:1. We are right now at 0.75, 0.8. So we are looking somewhere in the region of $3 to $4 trillion of market cap in the next 7-8 years. And we are right now at $1.5 trillion. So, you can see the kind of wealth which will be created from the equity markets. As far as mutual funds are concerned, I think we have seen that over a period of the last 15-20 years, Indian actively managed mutual funds have been comprehensively beating the benchmark. And there is no reason to believe why this will not happen at least for the next 5-10 years. So obviously, in well-managed mutual funds, irrespective whether it's Reliance or some of our very able peers, it makes sense to invest in active managed mutual funds, because there is definitely a case of beating the benchmark handsomely.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.